Welcome back to another weekly wellness pearl. Today we're going to be talking about loans and loans are really common. They're not talked about very much, but they are very helpful tools. And like any tool, we have to know when to use them and when not to. If you're in the midst of hunting for a loan, so that could be an online application with like SoFi or with your bank. What you'll need to know are a series of pieces of information that we're going to go through today, as well as what's the total cost of you borrowing. So if you're borrowing $2,000, you just need to know at a very basic level that you're going to end up paying back $2,100, $2,200. And what we're going to go through is 6 questions here that help you get a really solid base for loans. We're going to make sure this video is under 10 minutes so that you understand personal loans, whether you're paying for an upgrade in your home, an emergency, some extenuating circumstances, or if you're just borrowing to delay the immediacy of the payment and just pay an installment. So we're going to talk through those things. Gabe, glad you're here. Let's jump straight in.
Yeah, so we get a lot of questions about personal loans, and I feel like personal loans they haven't been discussed as much in the last maybe 10 years. We all know about mortgages for a home, we know about car loans, we know about credit cards, it is a kind of loan. It's like a revolving loan that we're constantly, hopefully, paying down, right? But personal loans can be used for a lot of things. So, for example, medical debt, car expenses, home renovations, any emergency situations that arise. People take out personal loans for vacations, things like that. But the most common application for a personal loan is for debt consolidation.
Yep.
So we teach this a lot when we're talking about paying down credit card debt. Really, really quickly, if you have 3 different credit cards with outstanding balances on them, they might be 15, 16, 17% interest rates, totaling $6,000 of credit card debt. Well, you can get one personal loan for $6,000 at, say, a 6% interest rate, pay those credit cards down. You still owe $6,000, but rather than paying it being spread out with 3 different cards, 3 different payments, 15, 16, 17% interest rates, you're in one consolidated spot with a lower interest rate.
Yeah, and those personal loans can come from a variety of places. You can typically get them unsecured, which means you don't need to have some kind of asset as collateral or like given up in exchange for the loan. They usually come with, a 4, 5, 6 year term, and the interest rate, like Coach Gabe said, is relatively low compared to some other borrowing mechanisms. The other thing that is important when you're looking at what does a personal loan do, it often ties you to some kind of long-term payout where you take a monthly payment every single month. Many banks will want you to connect it directly to a bank account when you do it. So if you don't already have a bank account that you feel comfortable doing that with, consider that as a first step before going after personal loan.
So let's discuss how we qualify, right? You know a lot about this stuff, especially, but in order to qualify for a loan, you're going to need to have your credit history. They're going to check your credit history, and they're going to check your debt to income ratio. So I'll let Coach Aaron talk about credit history since he has like 74, 5,
Many,
6
too many
credit cards. Oh, I can't say that without cringing. The debt to income ratio is simply each month, how much are you making in income versus how many other debt obligations do you have? So they normally don't count your primary residence, like rent for a place you're living or mortgage for a place you're living. But if you have a car payment, if you have student loan payments, if you have outstanding medical debt, other credit card balances that you're carrying, that'll be the debt part of it. And then what's your income like compared to that is a way that they can track and calculate, okay, are you actually going to be able to pay this off?
Yeah, and the other element of your credit score is, the breakdown of it is really important. So your credit score is going to be something they check fast. They'll end up checking what's called a Vantage score. We don't need to go into that right now, but they'll check your credit score. And in the preparation for a personal loan, you can always look to boost your credit score. If you have questions about how to do that, please reach out to us. We've got some really simple tips that we can give you to do that. That's a subject for some other time. What you'll also likely have to provide is some kind of proof of income. Often that can be pay stubs. You might have to do a bank statement, but they're going to want to verify that you have income coming in relative to what you're borrowing. If you're borrowing a low amount, a couple $1,000s, they may not ask for that. But if you're borrowing somewhere between $25,000, $30,000 or above, you may need to provide some more robust information to make sure that they feel comfortable giving you that loan.
Quick addition, I will add to that because I just tried to apply for a loan last year. We were all independent contractors, self-employed. So if you don't have pay stubs that you can show them, like salaried pay stubs, a lot of times they'll ask for your tax returns from the prior year.
Yep.
Right. So it's important to know that if you're an independent contractor or self-employed, in order to show your proof of income, you might be able to show invoices for clients that you have, but it might also be that you just give them your tax returns from the last year.
So the next question, when you're applying for these, a lot of times what these personal loan companies will do is soft check your credit, which means that it doesn't count as a hard inquiry. It doesn't negatively impact your credit. Sometimes that can be a really important tool when you're in the hunt for a solution. So if you're looking at, putting something new in your home, you're going to have a lot of time to prepare. But if you're in the midst of some kind of crisis and need help out, you may be worried, like, is this going to negatively impact my credit? And the answer for many companies is a soft check will not damage your credit.
Another common question we get is, how do rates for personal loans compare to other kinds of loans, right? A big thing to keep in mind here, like Coach Aaron said earlier, personal loans will almost always be better rates than credit cards because you're committing to a fixed time period, okay? But usually they're not going to be as low of rates as like a mortgage or a home renovation loan or a car loan, because in each of those situations, you have an asset, the home or the car, that is collateralizing or securing the loan for you. So if you can't repay, the lending institution knows that they can recoup their loan by seizing some of your asset, okay? So just know that personal loans fall somewhere in between, usually about 6 to 7% if you have a decent credit score. Credit cards are 12, 15 plus. Secured asset loans like home renovations, car loans, things like that, usually come in below 5 or 6%. A personal loan is going to get you in at right about 6, 7%.
And coming into the home stretch with our last two here, another one that comes up often is, what do I need to watch out for?
Yeah.
And when you get a personal loan, there are usually two things to pay attention to in the fine print. The first is, are there any fees associated with getting the loan? So if you are applying for it, it could be a fixed dollar. It could be a percentage where they're going to deduct that straight from the money that you get. For example, if you need to borrow $4,000 and you get a $4,000 loan, but the fee is $250, you're only going to be issued $37.50. So you may need to plan for that as you do your budgeting. The other thing to look out for is prepayment penalties. So some banks, some loan officers will not let you pay early. And that means you're tied to those payments. Even if for some reason you can pay it off and be done with it, you're not allowed to do it early without some kind of penalty. So that might cost you a couple extra dollars, a couple extra $100, depending on the loan. But it's important to know that going in. So make sure you read that fine print if you're going after a loan.
Definitely. And I'll just add one thing onto that. Sometimes if they don't charge you an origination fee, an upfront origination fee, they will have a slightly higher interest rate so that, they recoup the expenses from the higher interest rate. So just the third thing to check is check the interest rate, right? That's obvious. But that relationship between fees, penalties, and the rates is what you're really going to be looking for when evaluating this stuff. So let's bring this home. When is getting a loan a good idea, right? Sometimes you're in a bind and you need it and it's a good idea. Sometimes it's to buy something that's going to enhance your life and it's a good idea. Sometimes you're in a bind and it's not a good idea, or you're going to buy something to enhance your life and it's not a good idea. So how do you go about thinking when is a good idea to take out a loan?
It's always a tough question. And like many money problems or challenges, the answer is it depends.
Yeah.
So what we need to be mindful of is, what's the cost of borrowing? What's it going to cost me to put this money down for whatever reason? And then over the long term, can I pay it back? And those monthly payments, if you're adding up your months, your overall debt obligation can really expand quite rapidly. So mind your dollars, mind the numbers, know your interest rate, know the data, and make sure it fits into your plan. If you're committing to a 5-year payment of $100, that might not seem like a lot now, but if your income changes or there are any other shifts in your planning, maybe you have a kid or maybe you buy a new car, you'll want to feel the impact of that $100 in more than just the current moment. So plan ahead and look at, how is it going to feel to be obligated to this debt for the coming years.
I think that's a great way to put it. The last thing I'll add is, if you're purchasing an asset, we talk about this a lot in our growth content, in our wealth building material, where we can use debt as a leverage tool to be able to make more money, right? Like getting a student loan to get a good degree, to get a higher salary is a good use of leverage. Getting a mortgage to buy a house, to rent it out to somebody, to pay that off is a good use of leverage. So you might be a musician and you might need to buy, a certain instrument or a certain, piece of gear, whatever it is. And you might calculate that getting a $2,000 loan to buy this thing you can't afford, if you have a plan to earn more money from that,
Yep.
could be a really good use of that money, right? Purchasing assets so you can increase your income.
Yeah, and as a third, a lot of times you can use debt, a loan, to save money in the future, right? If you have, if we're consolidating debt, that's one example, but there may be things that you can pay off now, be done with it, and now you're free and clear. You don't have that straggling payment every single month. So know exactly why you're using debt, and that alone will help you. And if you can get clear on what the purpose is, what the dollar amount the cost is, where it's going, are you putting money into an asset? Is it going to have value over the long term? Or are you simply buying a new leather jacket? Are you buying something for fun? Know the difference, know your intentions, and ultimately it's going to be up to your numbers, right? It's going to be based on your budget, your income, your strategy. But along the way, any kind of answer based on it depends should fall back on some of the 5 questions that we answered earlier so that you know that you're being intentional, you're being thoughtful, and that this isn't just another very impulsive use of dollars that you don't have access to right now. Personal loans can be a great tool, but like any hammer, you can put a hole in the wall if you don't know how to use it. So we hope this has been helpful. Personal loans are a phenomenal tool. We want you to use them well, and we'll see you next week on our Wellness Pulse.